Why do Treasury bond yields vary? The pricing of bonds is all about how much the market discounts future cash flows. Let's consider a standard coupon bond with a face value of $1,000 and an annual coupon rate of 2% paid semi-annually, or $10 for every 6-month period. If markets discount the cash flows at a 2% bond equivalent annual yield, or a 1% semi-annual yield, then the bond will cost $1,000. But as market conditions change, the discounts that the buyers and sellers of the bonds may apply to these cash flows could either increase or decrease. For example, if the market only discounts the cash flows at a 1% bond equivalent annual yield, or a 0.5% semi-annual yield, the bond will be worth $1,094. So this drop in the yield by 1 percentage point raised the value by $94, or by 9.4%. If, in contrast, the market discounts the cash flows at a 3% bond equivalent annual yield, or a 1.5% semi-annual yield, it will be worth $914. So this increase in the yield by 1 percentage point lowered the value by $86, or by 8.6%. But why would a bond trade at different yields as time passes? Why would buyers and sellers of bonds agree on larger or smaller discounts of future cash flows? And why do some bonds carry higher yields to maturity than others? That is, why is it that the market is discounting the cash flows on some bonds at a higher rate than the cash flows on other bonds? To answer those questions, we have to return to the reasons why buyers and sellers in the bond market discount cash flows in the first place. Why would you not pay the undiscounted sum of the cash flows, or $1,200, for this bond? You as a bond investor need to be compensated for, 1, the time value of your money, the fact that $1 today is worth more than $1 tomorrow, and 2, any risk that you might be taking on, the fact that a safe dollar is worth more than a risky dollar. So changes in the discount rate or bond yield over time reflect either changes in the compensation the market demands for time, or changes in the compensation the market demands for risk. Time is straightforward, but what exactly are the risks we're talking about here? Since these are default-free Treasury bonds, it is not about default. What is it about? Well, there are 2 kinds of risks: the risks you experience even if you hold the bond to maturity, and the risks you experience if you might sell the bond before maturity. So regarding the first, if you're sure to hold a Treasury bond to maturity and plan to spend the money at that point, the only risk you're taking on is inflation risk. When you buy the bond, its price is determined in part by investors' expectations of what inflation will be. If inflation turns out to be higher than expected, your payments will not buy as much in the way of goods and services as you and the rest of the market had been expecting. For investors who are planning for a specific time horizon, say 10 years, the extent to which they are concerned about inflation being higher than expected will inform whether or not they invest in a sequential series of shorter-term bonds, say 10 one-year bonds or 5 two-year bonds, or alternatively a single 10-year bond. If you think the 10-year bond has adequate compensation for the inflation you're likely to experience, then you'd prefer that. If you're very worried, though, that the long bond does not adequately compensate for inflation, then you'll prefer short-term bonds. If inflation picks up, but you've been investing in short-term bonds, you'll at least be able to reinvest your proceeds in the new short-term bonds at higher yields. Had you invested in the long-term bonds, you're stuck with the low rates that don't compensate for the newly higher levels of inflation. That was all assuming you were holding the bonds to maturity and planning to spend the money at that point. If you are not holding the bond to maturity, you also face the risk that bond prices will change between now and the time you want to sell the bond for any one of a number of reasons. This is broadly called interest rate risk, since the risk that investors will discount the payments more during the time period after you bought the bond and before you sell it is related to changes in interest rates. To understand these reasons, we can very roughly decompose the yields on U.S. Treasury bonds, which are nominal in that they guarantee you a specified number of dollars but provide no guarantee as to how much consumption those dollars will provide. We can decompose these yields into the following pieces. The nominal yield equals the real yield plus expected inflation plus an inflation risk premium. The nominal yield is what you actually see. It's what's actually quoted when you look at a Treasury yield and what you actually receive in dollars. The real yield is what that yield would be in a world with no inflation. The expected inflation piece is the market's central forecast for inflation. and the inflation risk premium is additional compensation that investors might demand for bearing the risk that the inflation forecast is wrong. That last piece is in there, that inflation risk premium, because there is risk surrounding the forecast of how much inflation will be. The more uncertain that forecast is, the greater the risk premium that exists to compensate investors for the possibility that inflation could be much larger than expected. This means that if the yield on Treasury bonds changes, for example, from 2% to 3%, that generally boils down to one of or a combination of three things. One, the real discount rate has changed. Market participants suddenly require more consumption tomorrow to forego a unit of consumption today. Or two, expected inflation has changed. Market participants, investors, believe there will be more inflation than they believed yesterday. Or three, the risk premium for inflation has increased. Markets demand more compensation for the possibility that their inflation forecasts are wrong. The exact decomposition of the nominal Treasury yield on any given day into these three components is not a trivial exercise, not least because we also think there might be some additional factors related to the fact that Treasuries are extremely liquid. We actually do know what the real yield is from some special inflation-indexed bonds called Treasury Inflation Protected Securities, or TIPS. The payments promised in these TIPS bonds are real cash flows, meaning that the payments are guaranteed to rise with inflation. For much of 2012 and 2013, this real yield was negative, and there was a difference of around 2 to 2.5 percentage points between the real yield and the nominal yield. But it's not easy to back out how much of that difference is due to inflation expectations versus an inflation risk premium. Some estimates suggest that around 0.5 percentage points, which we also call 50 basis points, comes from the inflation risk premium. That means that the expected inflation priced into today's 10-year Treasury yield is about 2% per year. So market prices generally imply that investors believe inflation going forward will be consistent with today's inflation levels, which are historically rather low. The preceding analysis does not quite get to why these three factors might change. The inflation pieces would generally change because there was some news or change in beliefs about inflation. It must also be recognized that the Federal Reserve, the U.S. central bank, has a big influence on the market for bonds. The Federal Reserve does not have direct control over long-term interest rates, although it does have direct control over short-term interest rates through its open market operations. And there should be a tight relationship between the yields on a longer-term bond and the current and expected future yields on shorter-term bonds. For example, under an idea called the expectations hypothesis, the yield on a 2-year bond reflects the market's expectation of what return could be achieved if instead of investing in the 2-year bond, an investor invested in a series of 2 1-year bonds. In this notation, E sub 2013 of R sub 1 2014 is the market's expectation, as of 2013, of the yields that will prevail on a 1-year Treasury bond that will be issued in 2014. So suppose, for example, that the 1-year yield were 1% in 2013, and the 2-year yield were 3% in 2013. They're actually much lower. But suppose those were the rates. The expectations hypothesis suggests that investors in 2013 expect that the 1-year yields that will prevail in 2014 will be 1.98%. That's because 1.03 equals 1.01 times 1 plus this expectation of what 1-year yields the investors think will prevail in 2014, and that equals 1.98%. A similar relationship holds for a 10-year bond. The 10-year bond yield reflects today's 1-year yield, as well as the market's expectation of the 1-year yields that will prevail between 2014 and 2015, as well as the market's expectations of the 1-year yields that will prevail between 2015 and 2016, and so on. So the yield on the 10-year bonds could change because the Federal Reserve changes short-term interest rates, or it could change because markets change their expectations of the extent to which the Federal Reserve will change rates in the future. For investors who hold the bond to maturity, they will still get the same cash flows as they otherwise would have. But investors who might sell the bond early would be doing so at a higher price if yields rise due to the expectation that the Fed will raise rates, and a lower price if yields fall due to the expectation that the Fed will cut rates. Now, Many people invest in bonds through bond mutual funds, such as those provided by large mutual fund companies like Vanguard and Fidelity. These funds buy lots of bonds and pool them together. The bonds in the funds have an average maturity that stays relatively constant, since as each bond matures, it is replaced by a new bond in what is called a rolling ladder. If you are planning on liquidating the bond fund in order to spend the money, or if you need to meet a fixed liability, then this fund, or rolling ladder, subjects you to the interest rate risks inherent in buying individual bonds. You will be selling the fund at a point when the prices of the bonds in the fund might be higher or lower than they are today. So for those who are using bonds to fund fixed spending plans, it's much better to buy individual bonds in a non-rolling ladder that mature when you need them. For example, if you need to spend, say, $50,000 per year over each of the next 10 years, you can do so by buying 10 zero-coupon bonds, each with a face value of $50,000 and with maturities of 1, 2, 3, etc. up to 10 years. Such bonds can be purchased through brokerage accounts, although one has to watch that the fees don't add up. On the other hand, if you would be reinvesting the principal from the bonds anyway and not spending it or trying to meet some fixed liability, then there's no real benefit to receiving the principal back at maturity, and bond funds would be more appropriate for your purpose. And one also has to consider that bond mutual funds or exchange-traded funds, ETFs, are generally the most cost-effective way in terms of low fees to get exposure to the bond market. So, why do prices move around, even on what is probably the safest kind of bond, the Treasury bond? The simplest answer is that the market decides that future cash flow promises from the U.S. Treasury are either worth more or less to them than those promises were in the past. These changes might happen because investors require a real or purchasing power adjusted compensation for holding the bond, or because investors become more concerned about inflation. Both the real return that investors require and their views about inflation are likely influenced quite strongly by the monetary policy of the Federal Reserve.